Hello.
Howdy, everybody.
Pretty good.
Two, three, four, five, six, seven. We're missing Ian. Everybody else seems to be present. Today we're going to take a look at other post-retirement benefits and then transition into the chapter on stock transactions and the statement of owner's equity. Let's start the PowerPoint. And other retirement benefits. Most companies have pension plans that provide for future payments of retirement benefits to compensate employees for their current services. Many, but not most, companies also furnish other post-retirement benefits to their retired employees. These may include medical coverage, which could be either full or it could be supplements to Medicare, dental coverage, life insurance, group legal services, and other benefits. By far the most common is healthcare benefits. The accounting for these other benefits is similar to the accounting for defined benefit pension plans. There are two complicating factors for calculating post-retirement medical benefits. The amount the company's plan has to pay is normally after the employee's co-payment and after Medicare reimbursement is shown in this diagram. So we have the estimated medical costs in each year of retirement, and the actuary is going to have to estimate those in advance in order to determine how much the company is going to owe. But then how much of that does the retiree have to pay? And that's usually a copay, like if I go pick up a prescription, Blue Cross pays for most of it. I might pay a copay of $5 or $10 or even $40, depending on what the prescription is. But then currently Blue Cross pays for the rest. After you're retired, then you don't have the Blue Cross Blue Shield that Belhaven offers. You have Medicare. And so then that would be the net cost of the benefits that would have to be reimbursed by the plan. and we don't have time in this course to go over examples and calculations, especially now that we've lost a week because of the pandemic, quarantine, and so on. So we're moving on now to the statement of owner's equity and stock transactions. And I wanted to remind you about the accounting equation and its formats. The one we use for debits and credits in the balance sheet, assets equals liabilities plus owner's equity. But there's another way of looking at it, and that is that if a company has assets, its primary responsibility is to pay its liabilities, and after that is done, whatever is left over is for the owners. Now, going back to the original equation, it's set up that way because the left-hand side of the equation, assets, tells us where they have invested their resources. The right-hand side says where they came from. They came from borrowing or owner's investment or the profits earned by the owner. Second form is sometimes called the residual equity method or format. So that's what's left over for the owners. And a not-for-profit or government organization might think of it this way. Assets minus liabilities equals their net assets. And net assets is what is used by some government and not-for-profit organizations. The amount left over for the company is also called its book value and its net worth. Now, the owner's equity section for corporations. The name of this section of the balance sheet is not standardized. The instructor's PowerPoint for Chapter 18 gives these examples. Target called it shareholders' investment. General Electric called it shareholders' equity. FedEx called it stockholders' investment. Apple called it shareholders' equity. And Walmart called it stockholders' equity. But each of these titles conveys the exact same meaning. The statement of owner's equity is one of the 5 financial statements that corporations have to prepare according to FASB and international standards. Financial position, also called the balance sheet, income statement, statement of comprehensive income, statement of cash flows, and statement of owner's equity. A reminder of the format of the statement of comprehensive income. In that statement, it starts out by reporting net income, the same dollar amount that's reported in the income statement. And then they show the things that are other comprehensive income that make the difference between net income and comprehensive income. Typically, the 4 things are unrealized holding gains, or actuarial gains and losses related to investments. So that would be unrealized holding gains or losses. Then gains or losses on defined benefit pension plans, gains and losses on derivative investments, which we briefly touched on, gains and losses on foreign currency translation. So that would be unrealized holding gains or losses when you have a financial instrument that's denominated in a foreign currency translation. The statement of owner's equity includes information about the changes in other comprehensive income. So let's remind you from Principles 2 what's included in owner's equity. Recall that owner's equity may have the following components: preferred stock at par value, common stock at par value. So every corporation has that. That's why it's in bold. Every corporation would have additional paid-in capital, and every corporation would have retained earnings, or it could be a deficit, a retained loss, negative retained earnings, actually. Some of them will have accumulated other comprehensive income, and some of them may have treasury stock. Many will also have another item called non-controlling interests that will be taught in advanced accounting. And that's basically the amount of owner's equity that should be reserved for minority shareholders. And by that, we mean a corporation has control over another corporation because it has a majority of the shares, but they don't have all of them. A minority of the shares are owned by other investors, and so they set aside the amount that would be their particular interests because it would be illegal to take all of the, for example, if they closed down the corporation that they owned and liquidated it, some of the money that was left would have to go to the minority shareholders. So here's a diagram when you think about different kinds of securities, whether or not that they are debt or equity securities. So common stock has 4 characteristics that are in common with owner's equity. And that is that the amount of the return is not a fixed amount, it's variable. Do they have voting rights? Yes. Does the financial instrument have a due date, a maturity date? Does it expire? No. Is there a mandatory return? That is, are they required to make a payment to the investors? No. Preferred stock does not, actually it does have a fixed return, but I put no there because the return is not mandatory. So perhaps that should be a yes in that particular box. The amount of the return is usually fixed as a percentage of the par value or as in a specified dollar amount. Voting rights, preferred stock does not have voting rights. Does it have a maturity? No. Indefinite life. And is the return mandatory? No, you cannot pay a dividend on preferred stock unless you have the cash and the profits available. Convertible bonds. They're at one time bonds, but they can become stock. So when they are a convertible bond, they have a fixed return, no voting rights. They do have a maturity, and the return is mandatory. You have to pay interest. But once they convert into stock, then no fixed return. They do have voting rights. They have no maturity and no mandatory return. Bonds payable with a fixed interest rate have a fixed rate of return that's mandatory. They must pay the interest. They have a maturity, no voting rights. Bonds payable with a floating rate. A floating rate means that the interest rate can change depending on economic conditions. So the amount of the return is not fixed. They don't have voting rights. They do have maturity, but even though the amount of the return might change depending on economic factors, usually the interest rate, the return, they still have to make the interest payments. The subordinated debenture. We talked about that in the chapter on bonds. That means that they have a fixed amount of interest, no voting rights, it matures, but If they can't pay the interest on their other debt, then they don't have to pay it on this debt. So the return is not necessarily mandatory. Questions or comments on anything since we've gone over that section yet? Next topic we're going to take a look at is the preferred stock. So let's go to that. And I've got the wrong slide. Here we go. Preferred stock. Preferred stock is owner's equity, but as you saw in the table previously, it has some characteristics of debt also. As in debt, the amount of the return is fixed, the shares do not have voting rights, and the dividend payout has priority over common stock. But as in owner's equity, the return, which is a dividend, not interest, so it's not tax deductible, it's not mandatory. The company can decide not to pay it if they're having financial difficulties. And the return, which is a dividend, not interest, is subsidiary, next in line to debt. This is like owner's equity. Types of preferred stock. Cumulative preferred stock has the right to miss dividends before anything can be paid to common shareholders. Non-cumulative, if they didn't pay the dividend this year, then next year they have to pay them a double dividend before they can pay anything to the preferred or to the common shareholders. If they don't pay anything this year to the preferred shareholders, they can't pay it to common shareholders either. They have to pay the preferred stock first. Participating preferred stock has the right to get a higher dividend if the common shareholders are getting more than was stated for the preferred stock. Non-participating preferred stock does not have that right. Preferred stock disclosure. On the balance sheet in the financial statements, it can be stated either as a dollar amount, the dividend that is, or as a percentage of its par value. This rate is always disclosed on the balance sheet. Balance sheet must disclose the number of shares that are authorized, issued, and outstanding. I believe you learned what those three things meant in Principles 2, but let's review it. Authorized means according to their corporate charter, which is like their constitution. It says how many shares they're allowed to issue. Issued says how many shares they have sold to investors so far. And outstanding is how many of those issued shares remain in the hands of shareholders. Outstanding could be smaller for common stock because issued shares might have been repurchased as treasury stock. So authorized is always greater than or equal to issued, and issued is always greater than or equal to outstanding. Common stock. All corporations must have common stock, which are the ordinary voting shares. The balance sheet must disclose the number of shares that are authorized, issued, and outstanding, and they have the same meaning for common stock that they do for preferred stock. I think the difference is I'd never heard of preferred treasury shares. So for preferred stock here, issued and outstanding, I've never seen it when they weren't the same. But for common stock, the shares outstanding could be smaller than those issued. And we're going to be looking at treasury stock later on. So many corporations then also will report on their balance sheet the weighted average number of shares outstanding used to calculate earnings per share. But that's the next chapter. We'll do those calculations in chapter 19, which is the last chapter we're going to be able to cover during this course. Classes of common stock. Some corporations have different classes or kinds of common stock that may differ according to par value or to dividend rights or to voting rights or so on. This is not very common, no pun intended, but I couldn't think of a better way of putting it. Additional paid in capital. The market price that's paid for stock, whether it's preferred or common, is normally higher than its par value. The difference between the par value and the market price is reported as additional paid in capital, and it's also called paid in capital in excess of par. Par value, when the corporation registers its shares with the state government, when they incorporate and have their corporate charter, the charter says that the par value under business law in most states, it's the smallest amount at which they're allowed to sell the stock. They can't sell it for less than that. The textbook's examples often show multiple kinds of additional paid in capital accounts, depending on what created the additional paid in capital. Was it issuing stock? Was it reissuing stock? Was it treasury share purchases or reissuing them? Whatever. Every possible different thing that could cause additional paid in capital. In the textbook, they have a different account for it with a different name, but in real life, corporations combine them all into one single line on the balance sheet. Textbook examples often add preferred stock, common stock, and additional paid capital together and give a subtotal on the balance sheet called total paid in capital. This represents the total amount of investment capital received from owners. However, in real life, corporations usually omit this subtotal. Okay, before we move on to retained earnings, needed to stop and see if you have questions over the material we've gone over so far. And we are going to later go to exercises to illustrate the concepts, but what we're looking at right now is the background that you need to know before you can do the entries. So if there's no questions, then let's move back to the PowerPoint. And okay, so retained earnings. This represents the total profits kept by the company. Net income increases it. Net losses decrease retained earnings. Cash dividends decrease retained earnings. Stock dividends decrease retained earnings. Accumulated other comprehensive income is also in the shareholders' equity section of the balance sheet. The changes in OCI are reported both in the statement of comprehensive income and in the statement of owner's equity. The balances in OCI that have accumulated over time are disclosed in the balance sheet. Net gains add to shareholders' equity. Net OCI losses decrease shareholders' equity. And we'll look at an example of a statement of owner's equity later on, but we still have not discussed all of its components and defined them. Another component of shareholders' equity is treasury stock. Treasury stock is the temporary withdrawal of shares from active ownership. Treasury shares have been issued, but they are no longer outstanding. Characteristics of treasury stock. Treasury stock is a contra owner's equity account. The normal balance of owner's equity is credit. So this has a debit account. So don't think of it as an asset just because it has a debit account. It's contra owner's equity because it's a withdrawal of investment. Treasury shares have no voting rights. Treasury shares cannot receive dividends. They're sort of suspended animation. Reasons for treasury stock. There are three main reasons for a corporation to purchase its own shares. First, to prevent a hostile takeover. Second, to give to employees as a bonus. And third, to have on hand in case of the exercise of stock options. So let's back up a little bit and refresh your memory about what a hostile takeover is. What's a hostile takeover?
Hostile takeover. Can you hear me?
Yeah.
Isn't a hostile takeover when another company buys like 50% of their stock or something like that? More than 50% of their stock?
Well, that's a takeover. What makes it hostile?
Is that they bought it from other shareholders?
Okay, well, again, that would be any takeover. What makes it hostile is that they're trying to get control over the corporation, and the current board of directors are not happy about it. They don't want this other company to take over. They think they might lose their positions. They're trying to keep their company independent of the other company. And so let's go back to the share screen and think about the I've got so many windows open, it's hard to find. So if they have the hostile takeover, that's in progress, that means that they know that some other corporation is trying to buy enough shares to get control, which would be over 50%. And what they can do then is the company itself can buy shares in the stock market. And that means that there's fewer for this other company to be able to purchase. So it blocks the hostile takeover. Does that make sense? Okay, so some companies give shares of stock to employees as a bonus or as part of the regular pay. The thinking is that this is an incentive pay, because if their pay is tied up with the company's shares, then they want the company to do well to increase their wealth, and therefore they're going to be possibly working harder or more efficiently or something. Stock options, people have the right to purchase shares, so they want to have them ready without having to issue new shares. So next time in Unit 7, we're going to look at treasury stock transactions. Now we need to take a look at the statement of owner's equity. And the way that you learn it in Accounting Principles 1 is okay for a sole proprietorship, but it's going to be different in a corporation. the statement of owner's equity in a corporation is divided up into columns that explain the changes that took place in the corporation's owner's equity accounts. So let's briefly jump ahead to the next slide so you can see this. I took the 2018 annual report for Amazon and their statement of owner's equity. I simplified it by adding a couple of columns that had small amounts in them. So what you see is it's tracking, each color here is a different year. Green is what happened in 2016. Then the yellowish is what happened in 2017, and the blue is what happened in 2018. So for each of these accounts, they show what was in the account at the beginning of the year, what caused it to change, and how it got to its ending balance. So the darker color here, the ending balance, that is the amounts that will be on the balance sheet of the company for that particular year. So the same numbers are on the balance sheet. In accounting, we call this articulation. Articulation in accounting means that the statements are connected to each other because they have the same number on both of them. So this statement connects to the balance sheet with these accounts here, and it connects or articulates to the statement of comprehensive income by showing these changes here in this particular column. So common stock, additional paid-in capital, treasury stock, other comprehensive income, retained earnings, and the total. So let's go back. So it has a column for invested capital, separate columns for preferred stock, common stock, and additional paid-in capital may be used. Usually all of the different kinds of paid-in capital accounts are combined into a single column. They have a column for retained earnings, one for other comprehensive income, and one for treasury stock. And then the rows show the changes during each year. So let's take a look here at their last year that was prepared. Actually, their 2019 report should be coming out fairly soon. Usually, they have January, February, and March. They're preparing the financial statements and having them audited in order to release them in April. So beginning of 2018, their common stock had $5 million in it. Nothing significant happened. It's $5 million at the end of the year. Additional paid-in capital was $21,389,000,000 at the beginning of the year, $26,791, or $26,791,000,000 at the end of the year, for a change in $5.4 billion. And that was a whole bunch of things put together that I think really would be from advanced accounting, so we don't need to go over that. The treasury stock remained constant during the year. Accumulated other comprehensive income was a loss of $484 million at the beginning of the year. They recorded a $4 million increase in loss because they changed an accounting principle. They had other comprehensive income loss of $547 million. So the ending balance, $1,035,000. Retained earnings at the beginning of the year, $8,636,000,000. An accounting principle changed that by $916 million. Net income, $10,073,000,000. So ending balance, $19,625,000,000. Owner's equity at the beginning of the year, owner's equity at the end of the year.
Hey, do we know how much Jeff Bezos owns of Amazon? Or do you know off the top of your head?
I do not know, and I would have to look it up.
What do you think? Like at least half?
No, I'm sure it's not half. Usually, when you have a major shareholder who's on the board of directors or CEO or whatever, they have to include that person's ownership in the papers filed with the SEC, because they are always concerned about insider transactions. And the other word that they call that is
Insider trading.
transactions, related party transactions. So in the beginning of the Form 10K that has to be filed with the SEC, they talk about related party transactions. So it's probably in there somewhere, but I don't have time to look it up. Okay, so let's move on to share the screen again and open the PowerPoint. We're going to start taking a look then at common stock transactions. And when I say common stock transactions, I don't mean stock transactions that are common. I mean transactions of common stock. So most states have laws, as I mentioned, saying that common stock can't be issued for less than its par value. So the par value is included as part of the entry to record the issuance of stock. So this is from exercise 18.4. Wright Medical Group filed to sell 3 million shares of common stock. The par value is 1 cent per share. The shares sold for $17.15 each. So notice that this $17.15 is the market value. That really has very little to do with the par value. All that 1 cent means is that it would not be legal for them to issue a share for less than that. The entry in the books of the company would be a debit to cash, 3 million shares times 17.15. Credit common stock for the par value, 1 cent times 3 million, $30,000. And the difference is additional paid-in capital. The book would have expanded that by calling it something like additional paid-in capital from stock issuance transactions. But I'm not sure that provides an investor with useful information, and I've never seen that kind of breakdown on a balance sheet. Non-cash issuance of common stock. Stock may be issued in exchange for other assets or even services contributed by investors in lieu of cash. So here is 3 transactions. February 12th, EDL sold 2 million shares, $1 par for $9 cash. February 13th, they issued 40,000 shares to attorneys in exchange for legal services. November 15th, they issued 380,000 shares in exchange for equipment with a fair market value of $3,688,000. So here's the entries. February 12th, $9 a share times 2 million shares, debit cash 18 million. $1 par times 2 million shares issued, credit common stock for $2 million. And the difference is the additional paid-in capital. Also called paid-in capital in excess of par. Now, if the shares were worth $9 on February 12th, it's a pretty fair assumption that they're still worth about $9 on February 13th. Unless the stock market's in the middle of a big crash or something, that's a reasonable assumption. So we're going to assume that the shares that the legal team got in exchange for their services were worth $9 each. $9 times 40,000 shares. Debit legal expenses, $360,000. How did they pay for this legal expense? By giving them stock, 40,000 shares, $1 par, and then the difference is the additional paid-in capital. Then on November 15th, they issued stock for equipment with a fair market value of $3,688,000. Par value for that is $1 per share times 380,000 shares, 380,000. So the difference between the fair value of the equipment that they got and the par value is $3,308,000. So that's also additional paid-in capital. They got something from investors that was over and above the par value. Retiring common stock. Treasury shares are shares that are issued but which are temporarily not outstanding. That is, they are temporarily withdrawn from circulation. On the other hand, retirement of shares is the permanent withdrawal of shares from ownership. Retired shares revert to the status of unissued. Shares might be retired in order to consolidate the ownership of a select group of investors. Again, this was something that they might do if they're worried about a hostile takeover. They could buy treasury shares and then retire them, and that would mean that these outside investors could never get their hands on them. So here's an illustration. Borland Corporation had 170 million shares of $1 common stock outstanding, no preferred shares. The average issuance price of its stock had been $34 a share. Thus, the average paid-in capital averages $33 per share. On January 2nd, Borland purchased 10 million shares at $32.50 a share and then retired them. And then on March 3rd, they purchased another 10 million shares at $36 a share. So here's the entry for the first repurchase. And the shares that they purchased were $32.50. In the past, the average issuance price was $34. So here's what they're going to do. Common stock is a credit account. They're retiring the 10 million shares, so they debit common stock $10 million. It had previously been credited when they originally issued it. Now, the additional paid-in capital of the shares being retired was $33. So 33 times 10 million is 330 million. They're reducing additional paid-in capital by 330. Credit cash for 10 million shares for which they paid $32.50, $325 million. The amount investors had paid for the old shares averaged 340 million. They bought them for 325. So the difference is 15. That's not a profit because it came from owners of the company. So they're going to credit paid-in capital for $15 million. Now, some companies might have netted the difference between these two and just debited additional paid-in capital for $315, but technically this is the way it should be done. Second repurchase, it didn't say actually that they retired them, but since this is about retirement, let's assume they did. Another 10 million shares retired, debit common stock 10 million. The average cost of the old shares had been 34. So again, 34 minus 1 par is 33. Debit additional paid in capital 330. Credit cash, they paid $36 per share, 360. So there's a difference here of $20 million. They paid more to get these shares that they're retiring than they'd gotten when they issued them in the first place, $20 million difference. So the first thing they're going to do is get rid of this $15 million paid in capital share repurchase. And that's still not enough. So now they're going to record a loss, $5 million to make it balance. So if you buy them for less than the original amount, you credit a paid in capital account. If it's for more than the original amount, you decrease retained earnings. So that ends this unit. So this would be a good time to quit. We've gone the full 45 minutes. And you've got plenty of homework problems to work on. Remember that the final exam will be the biblical integration from the chapters since test 3. I'll be giving you a study guide. Also, I posted an email to you all today reminding you that since this is Holy Week, there's no class scheduled on Friday and no class scheduled on Monday next week. Since that was Easter Monday and originally it was supposed to be a holiday. There's no religious reason for getting that Monday off, but in the past, Belhaven thought that if students who didn't live too close nearby wanted to go home and spend Easter with their family, then they'd need to come back on Monday. So that's why Mondays have been off after Easter. So if there's no questions, then I'll end this meeting and see you again on Wednesday. All right, see you then.